And as a former hard money lender, we had to foreclose against borrowers, and these were all commercial loans. There's a much different process. I shouldn't say process. There's different rules and regulations behind
Yeah.
foreclosing on commercial loans versus residential, but you need to know how long is it going to take and how much is going to cost if you have to foreclose on that asset, and that should go into your pricing model when you're buying these notes. What's your take on that, Fred?
No, absolutely. Completely agree. There's different laws and rules and process, both. And that changes from state to state. And so if you're buying loans in a particular state, you want to be familiar with the particularities of that jurisdiction.
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck, and today we are talking about the wonderful world of note investing. And Fred Moskowitz, he's a really, really intelligent man, came from the tech world, and honestly, I think the note investing topic is something that probably scares a lot of people. It seems like it's hard or difficult because it's paperwork, but I really I had that same feeling, and that's why I'm saying that. But I really have learned the opposite, especially as I was a hard money lender for years, and other people in my network that are note investors. Before I bring Fred on, I just like always take a second to say thank you for being here. Anything that we can do here at the Generations of Wealth to help you, please don't hesitate to reach out. Hit us up at the website, thegenerationsofwealth.com or derekdombeck.com, and let us know what we can do to help you. So with that, let's bring on Fred Moskowitz. And here he is all the way from Philly, Mr. Fred Moskowitz. How are you doing today, Fred?
Good morning, Terry. Doing fabulous. Thanks for having me.
Absolutely, absolutely. Well, Fred, I like to start off all my shows just having you kind of tell us about yourself and a little bit about your background, where you come from, and then we're going to dive into the incredible topic of note investing.
Fabulous. Little bit about my background. I started out my career working as a computer engineer in the tech industry. And when I got started, it was during a very exciting time, the dot-com boom. And so I found myself working at all these different startup companies, internet startup companies, and the internet was just getting going. And it was a really exciting time. And I went through the dot-com boom, and then a number of years later, the bursting of the dot-com bubble. And we had the September 11th terrorist attacks and a lot of shaking up, a lot of turmoil in the world. And through all of that, it made me realize that I was taking on a huge risk because I was relying on the paycheck from my job as my only income source,
Mhm.
right? And so even though I loved the work I was doing, I found that it didn't matter how good of an engineer I was or how valuable of an employee I was. The bottom line was that if things weren't going well in the industry or in the economy, I could lose my job through no fault of my own. And so this risk, this uncertainty really is what motivated me to start getting involved in alternative investments. And why is that? Because I wanted to diversify my income and have other sources of income. And so that's how I got started. I got started in real estate investing, which went really well. And then a number of years later, I started to learn more and more about mortgage note investing, which is the debt, investing in the debt side of all of these real estate transactions. And so that's how I got started. And it's been a wonderful journey for me.
That's awesome. So, you went through that. What kind of led you to notes? Because that's what we're going to talk about primarily today.
Yeah.
And we're also going to talk about the Little Green Book of Note Investing, which is your book that you wrote. So, I guess take us into maybe, most of my listeners are pretty well versed, but there's different types of note investing. So maybe hit on the different types, and then specifically, what do you like?
Yeah, absolutely. And you're exactly right, Derek. There are many type of notes out there. So what is note investing? Consider this. A lot of people love investing in real estate, right? Whether it's single family houses or commercial properties, multifamily properties, even vacation properties doing short-term rentals. A lot of people are into that. Now, what if we talk about investing in the paper, which is the notes and mortgages associated with all of those properties? We're investing in the debt. This is a really interesting part of the real estate business. And from speaking with a lot of investors throughout my career, I've noticed that a lot of investors, they don't pay any attention to this part of the real estate business. A lot of investors, when they think of a note and a mortgage, they think about it from the perspective of being the borrower and not as being the lender. So with note investing, what it allows us to do is step across the aisle and become the bank. And so we can transition from being the one making the monthly payments to being the one receiving those monthly payments. And this really can add a very steady and stable cash flow component into all of your investing activities. It's very powerful.
So uh, there are notes that are performing. There are
Mhm.
non-performing notes. There's partials that you can buy and sell.
Yes.
Um, I guess describe that, and then what are the pros and cons of each?
Sure. Performing notes means that the note is performing as agreed. Payments are being made, everything is going smoothly. That's a performing note. That's definitely the lowest risk type of note. Non-performing notes is where a default happens. Traditionally in the industry, if a loan is 90 days or more delinquent, it becomes categorized as a non-performing loan, and then collections gets involved, and uh, there's more risk with those. Those can be bought and sold. Next one you mentioned was partials, which I love. It's a great strategy. Partial is where you're, instead of buying a whole note and outlay of all that capital, then you can instead buy or sell a partial, which is just a portion of the note. In other words, let's say you have a 30-year note, 360 payments on a payment stream. You could sell a partial for 2 years of payments. And so the partial buyer um, buys that payment stream, and for 2 years, they'll receive those payments. And then after that has concluded, they've got all their money back plus their profit, and the payment stream reverts back to the underlying note holder. That's what a partial is, which is a great strategy for someone that maybe doesn't have a lot of capital, or maybe you're investing out of a retirement account, Roth IRA, or an HSA that doesn't have a large balance in it. You can buy a partial to get that money going, to get some velocity going. It's a great strategy. I definitely cover this in detail in my book on note investing, but it's a great way to build up retirement accounts that are small.
And just
So those are some of the differences. But personally, I like performing notes. That's what I focus my business on. Um, it's a strategy and it's a preference, but I've found it works well.
Yeah. Just to throw some quick numbers to it. So if I wanted to buy 24 months of payments on a partial note purchase, and the monthly payment was $1,000 a month, so that would be $24,000 coming in over that 24 payments, and maybe the face value of the note was 6% interest.
Mhm.
What could I expect to buy that partial note at for a discount?
That really varies. It depends on so many different risk factors. But if we're just making an example, maybe you bought uh, um, that $24,000 partial. Maybe you bought it for 22,000 or maybe 20,000. And what happens when you do that is the borrower's paying 6% as agreed in their
Mhm.
promissory note, but your rate of return goes higher. It'll go to 7 or 8 or 9% based on that discount. And this is standard practice in the note industry. When you buy a note, they're bought and sold at a discount. So it's less, you're selling it for less than the amount owed on the principal balance. And so that allows your rate of return to become higher than the interest rate being paid by the borrower because of that discount.
Right, because if there was a $100,000 principal balance, you wouldn't pay $100,000 for it. You would have a zero yield. So you have to buy it at a discount. What factors in? And I know there's a long list, but we're going to hit a
Yeah.
few of them.
Yeah.
What
No,
factors into that?
absolutely. Uh, so mo probably the first and foremost is payment history. Are all payments made on time? Or is there a history of missed payments or the borrower getting behind and then getting caught up again? Or is the borrower in bankruptcy and now there's a bankruptcy trustee managing their finances and making the payments out of the bankruptcy? So you have all of these different scenarios. Along with that is the equity position. How much equity is protecting that note? It could be a high amount. It could be a nominal amount or partial equity or none at all. It could be a note where the property's upside down. They owe more on the property than the value of it. And all of these different factors will impact the pricing, as well as the real estate market. Is the property located in an urban area or a suburban area that has a good local economy, or is it out in a rural area where the scenario looks very different? And so these are all some of the different factors that we look at when purchasing a note to assess value and assess the risk involved.
And I would probably add one more, and I'm not giving anybody legal advice, and I'm assuming Fred isn't either, but it's going to depend on the foreclosure laws in that state because I'll use Wisconsin as an example. And as a former hard money lender, we had to foreclose against borrowers, and these were all commercial loans. There's a much different process. I shouldn't say process. There's different rules and regulations behind
Yeah.
foreclosing on commercial loans versus residential, but you need to know how long is it going to take and how much is going to cost if you have to foreclose on that asset, and that should go into your pricing model when you're buying these notes. What's your take on that, Fred?
No, absolutely. Completely agree. There's different laws and rules and process, both. And that changes from state to state. And so if you're buying loans in a particular state, you want to be familiar with the particularities of that jurisdiction. And so one of the most important members on your team is going to be your attorney, your legal team. And yes, you need to engage an attorney in every state where the property's located that's securing that loan. We buy nationwide. We buy loans all over the US. And so, yeah, you start to build up a network of attorneys that you work with to help you with doing analysis and research and any legal work that comes up. But certainly, you want to get familiar with that because it's on a state by state level.
Yeah, and some people have a different, I guess, appetite for risk. So, you may look at a note and see that there was three missed payments or three late payments, let's say, in a 12-month period, and think, that's just not something I want to deal with. Whereas I, as a real estate investor, and the number one rule in lending when I was a hard money lender was never lend on something you wouldn't want to own because someday you might. And as a real estate investor, if we had to take a property back, okay, if it doesn't sell at foreclosure auction, we can put it in our portfolio and finish the project, sell it off, or keep it as a rental or whatever. But if you're truly a note investor or like a typical bank, they don't want to own real estate. They're more risk averse. So again, everybody has a different appetite.
Yes, absolutely. Everyone has a different appetite, different comfort level, different amount of time available to dedicate, right? That's a big one. Um, not everyone is going to be able to get hands-on and dig into a deal. So, like you said, if you're involved in hard money lending and originating those type of loans, you may have to be prepared to take over a rehab in the middle of the
Mhm.
middle of the process, take it over and finish it out. And are you okay with that? So there's a lot of those considerations that come up.
Yeah, and I have friends that like to buy defaulted loans and then try to do workouts with the borrower. So they're buying them at a deep, deep discount, but they try to do workouts with the buyer, loan modifications, forbearances, things of that nature. And if it doesn't work out, they are fully prepared to take the property and do what they need to do with it. Um, you had mentioned you like performing notes.
Yes.
Maybe you can talk about the difference between buying from institutions versus private notes.
Yeah, sure. The majority of what we look at and buy are institutionally originated notes. Banks and lenders, um, are their business model is to originate notes and then sell them, usually within 3 to 6 months after origination. And that's what the area that I like to focus on. One of the main reason is that's the most of what's available in the marketplace to buy. Um, Single family homes, there's a huge demand for financing. That financing has to be originated, it gets sold, and so there's an abundance of notes available. And that's what we focus on because there's the most opportunities for us to do that. And there's a level of consistency that comes. Bank originated loans, they're serviced by a professional loan servicer. There's a tight records being kept. So it makes it very easy to do analysis and due diligence on those assets. Now, when you get into um, seller finance notes, which are very popular, especially in certain regions of the country. And I have colleagues in the industry, that's what they focus on,
Mhm.
is they like to buy seller finance notes. And so with that, there's a lot more variation in the product and the legal documents, as well as the servicing on that. And uh, for some folks, that's what they're comfortable with. That's what they know and the business they're in, and they focus on that. And there's no right or wrong answer. It comes down to What's your risk tolerance and what you're familiar with and your skills and expertise in handling those type of assets.
Would you say on average the yield is lower buying the institutional originated notes versus private notes, or is it all over the map?
Yeah, it's all over the map.
Okay.
No, I wouldn't say it's lower or higher across the board. No.
Okay. What do you target for a return on investment when you're note buying?
That really varies with the risk profile of the note. It also varies with the cost of capital.
Hmm.
So, if we're working with leveraged money, it's a whole different scenario than working with idle cash sitting in a self-directed retirement account where the cost, right, your cost of funds
Right.
is very different. And so for each investor, you have to consider that in what you're doing. Are you borrowing funds and leveraging using a different asset you have, right? That's a scenario. Or do you have cash because you exited some other transaction or sold an asset and now you have actual cash in the account and that changes the scenario greatly. And so, for each asset you're purchasing, you want to consider what's your cost of capital, and you know, over the past few years with the changes in interest rates, that's been a big consideration.
Yeah. Well, and I know, and I don't know the year that it happened, but quite a long time ago, you used to be able to, you mentioned sell off an asset, sell off a real estate asset and exchange, do a 1031 exchange into notes. That is absolutely not, let me be clear, not something you can do today.
No,
But the where I'm going with this comment is taxation, right? One of the things that people love about real estate is the tax advantages. When you buy and sell notes, you don't get depreciation. You don't get you also don't get the joys of being a landlord either. But talk about the taxation a little bit and
yeah,
again, we're not giving tax or legal advice. So
no, not at all. We're just talking
yeah.
about reality. So here it is. With note investing, it generates tax liability, a lot of it.
Hmm.
That's the bottom line. Uh, you're going to have capital gains, you're going to have interest income. And you don't have, like you said, Derek, you don't get the deductions like you do with owning property and having depreciation. And so, note investing is an activity that generates tax liability. Now, a strategy I love, and I dedicated a whole chapter to this in my book, is if you're able to do note investing inside of a tax advantaged account, like a self-directed IRA, a Roth IRA, then the scenario changes dramatically. And so I always encourage investors look into this, explore this strategy, see if it works out for your particular tax situation. But if you, as an example, if you have a Roth IRA, you can buy notes, own them in the IRA. The IRA receives the payments. If it's a Roth IRA, there is no taxable um, scenario at all. It's 100% tax free. And that's a beautiful thing because if you have money that can grow and compound tax free, the rate of growth is geometric there compared to after tax. And so look into that, see if it works for you. For investors, whether you're in real estate, notes, whatever you do, look at these tax advantage accounts and learn how to do some, at least some percentage of your overall deal flow in those accounts. And that can be a great strategy.
The one caveat to that I've cautioned people on is keep enough money in your IRA, or at least be able to contribute to your Roth IRA in that year in the event you have to start a foreclosure action, because the IRA has to pay for all of that. It owns the note. You don't get to take money out of your personal pocket to go pay for something that your IRA doesn't have money to pay for. Am I speaking out of school there, Fred?
No, there's definitely a lot of rules. Any costs that are associated with the note, even servicing fees, anything like that, that has to be paid out of the IRA. There's a hard line of separation. You can't commingle funds, and there's rules involved, and so uh, it's important to understand how that works and what the restrictions are. But you know what, Derek? I've found that the IRA custodians are really good at providing education on how to be compliant, how to do everything appropriately. They're going to make sure the last thing they want is for one of their account holders to make a tremendous blunder with their account and have a taxable event, or have their IRA get disqualified, or any of these things, which um, they're avoidable, but if they happen, it's serious consequences.
Oh,
And
yeah.
so, yeah, so definitely rely on your custodian for guidance with that, but it's not hard to follow the rules. Just understand what they are, be educated, and you'll be fine.
Yeah, absolutely. And we've had guests on the Generations of Wealth show before talking about, IRAs and not no investing in it, but utilizing your IRAs. So you can go back and search through the archives for that too.
Yeah.
I'd give you the actual show, but I honestly don't know which one it was. So, um, well, Fred, I do like to ask people this very, very hard question. So prepare for it as best you can. What is one question I should have asked you that I did not?
A question you should have asked me but did not.
Mm-hmm.
Um, hmm. Okay. Here's an important question, especially when it comes to note investing. Um, a lot of people come to me, they say, "Hey, Fred, I love this. This sounds like a really compelling asset class. I want to learn more. How do I get started? How do I get started?" And so the conversation that I like to have is this, it's based on this one thing. How much time do you have? How much time do you want to dedicate to this activity of note investing? And for each person, it depends, because you may be a busy professional or a business owner, and you're focused on your career, you're focused on your business, and you don't have a lot of time. And so, if that sounds like you, then a great way to get involved in note investing is as a passive investor, and you can invest in a note fund. What's a note fund? A note fund is where the fund managers raise capital for investors, they pool it together, and then they go out and buy notes in bulk quantity and manage the portfolio and pay a rate of return back to their investors. So it's really a passive investment. For some people, this is a great option because uh, they don't have time to build relationships with note sellers, to find deals in the marketplace, access to that, managing a portfolio. So that's the scenario for someone that has very little time. And someone else may come to me and say, "Hey, Fred, I've got a lot of time. I want to learn this business." Great. Well, that's for someone that wants to roll up their sleeves, get your hands dirty, get out there in the marketplace, build relationships, find notes to buy, assemble a portfolio, manage it. And that's great. If that's you, it's a great business. I love it. Um, I'll say it's not for everyone, but that's okay. Each person has different needs and desires and goals in life, and that's totally okay. So this is a question, it's very important. There's no right or wrong answer, but it comes down to time. How much time do you have? And do you want to be a passive investor or do you want to be an active investor? And then see which one makes the most sense for you and your individual situation.
Absolutely. And there are so many different scenarios that we couldn't possibly touch on them in 6 shows in a row. But I would say the reality is it's like any other asset class. Go and find the right people that have the experience, get behind them, follow them. Fred's got the little book of note investing. Fred, how do people find that?
Yeah, the Little Green Book of Note Investing, that's the title. You can find it right on Amazon. Search for it by name, or you can search under my name, it'll come right up. And what I set out to do when I wrote that book was to provide a high level overview of note investing, the note investing industry, what is note investing, how to get started, and how to perform due diligence, analyze notes, how to find notes. And if you're looking at passive investing, how do you find a note fund and how do you analyze that and understand that? And I have 2 chapters dedicated to one of my favorite topics, which is how do you do note investing out of a tax advantage account, self-directed retirement account, Roth IRAs, any of those. Super powerful strategy. And so you can find that book right on Amazon. It's called The Little Green Book of Note Investing. And if you want to get in touch with me, you can visit my website, which is fredmoskowitz.com. Or if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. It'll take you right to my website. I have a special report available on note investing. I'm happy to send that out to you. Just visit the site. You can ask for it or send me a message. I always love connecting with investors. So many investors do so many different things, so many strategies, different asset classes. I love learning about that. So feel free to reach out, connect with me. And it's one of the biggest things we do is building relationships in this amazing world of investing.
And that's why I love this show, because I get to talk with people like yourself and other great guests. And I think Fred wrapped it up exactly the way we would like to wrap it up. Go out there and find the people, build your network. That's what this whole business is all about. That's how we build generational wealth. It's not just financial, it's building generational relationships. Finding the people that are your people and
Yeah,
our people. It's not,
100%.
yeah, it's not necessarily going to be the people you grew up with, the people that you are living next to as neighbors. We're kind of a rare breed, but we're a pretty fun breed. So, well, Fred, thank you so much for joining us today and sharing about the wonderful world of note investing.
Thank you, Derek. Thank you. It was a pleasure.
And for everybody else that typically is here, you know the drill. Please help us share this, get the message of Generations of Wealth out, share this show, give us all the social media likes, loves. If you just found us, hope you come back. We appreciate you. Till the next show, go live your vision, love your life. See ya.